Did you know that by May 22nd, a silent IRS kill switch could officially trigger a financial domino effect, potentially forcing thousands of seniors to hand over their house keys? It sounds like a conspiracy, but the math is terrifyingly real. While you've been distracted by the news, a specific 2026 tax provision has reached its boiling point, creating a liquidity trap that targets home equity like a heat-seeking missile. We are talking about a massive scientific shift in how the government views your property and your retirement accounts. Is your family home actually a ticking time bomb? Stick with me for the next few minutes because I'm revealing the hidden IRS May clause that nobody is talking about, and the one move you must make today to keep your front door locked for good. Number 1. The May myth. The rumors of a May eviction are spreading like wildfire, but as an expert looking at the cold, hard data, we need to separate sensationalism from the scientific tax timeline. The viral May 2026 date actually stems from a very specific IRS provision known as the Disaster Relief Extension, specifically IRS Bulletin TN 2026-01. While the rest of the country is rushing to file by April 15th, taxpayers in federally declared disaster zones, like those recently hit by Winter Storm Fern, have been granted a reprieve until May 22, 2026. This isn't a grace period for everyone. It's a high-stakes deadline for vulnerable seniors in specific regions who are already struggling with property damage and displaced records. If you miss this hidden May window, the IRS's automated enforcement systems don't just send a friendly reminder. They trigger immediate failure to pay penalties that can compound at a rate of 5% per month. For a senior homeowner on a fixed Social Security income, these penalties create a liquidity trap, where the debt eventually exceeds their ability to pay, leading to a tax lien, the first step toward a forced home sale. This isn't a theory, it's a calculated result of missing a deadline that most people don't even know exists. You need to verify your status on the official IRS disaster relief map immediately to ensure you aren't walking into a trap by assuming the standard rules apply to you. If you found this breakdown of the May myth eye-opening, make sure to hit that subscribe button and turn on notifications, because we are diving deep into the 2026 tax shifts all month long to keep your home equity safe. Number 2. The TCJA sunset. The looming expiration of the Tax Cuts and Jobs Act (TCJA) is not just a footnote in a dry tax manual, it is a structural snapback that could fundamentally alter the math of staying in your own home. On January 1, 2026, the temporary tax brackets that have governed our economy since 2018 are scheduled to reset to their pre-2017 levels. Scientifically speaking, this isn't just a minor adjustment, it is a significant shift in marginal tax rates that could push a senior's effective tax bill up by thousands of dollars. For someone on a fixed pension or relying on 401k withdrawals, this tax cliff acts as an invisible mortgage increase. When your after-tax income drops because the 12% bracket jumps back to 15%, or the 22% bracket climbs to 25%, that missing cash is often exactly what was earmarked for rising property taxes or home maintenance. Vividly imagine the liquidity squeeze. Your home's value has likely doubled in the last decade, leading to higher assessments, while your take-home pay is simultaneously being strangled by these reverting federal rates. This creates a pincer move where the cost of living in the home outpaces the income protected by old tax laws. Furthermore, the expiration of the $10,000 state and local tax, SALT, deduction cap is a double-edged sword. While it might offer relief to those in high-tax states, the overall loss of the doubled standard deduction means many seniors will lose the shield that currently keeps their Social Security income tax-free. To fight back, you must treat your 2026 tax planning like a productivity project. This means evaluating bracket climbing risk now and considering accelerating income into 2025 while the rates are still low. Preparing for this sunset isn't just about accounting. It's about building a financial fortress around your front door before the laws revert and the squeeze begins. Number 3. Standard deduction drop. While much of the 2026 panic centers on tax brackets, the true silent killer of senior home stability is the drastic reduction of the standard deduction. Under the current Tax Cuts and Jobs Act (TCJA), the standard deduction was nearly doubled, allowing the vast majority of seniors to shield a significant portion of their income without the headache of tracking every receipt. However, as we approach the 2026 tax cliff, that shield is scheduled to be cut by approximately 50% as the law reverts to its pre-2018 structure. For a senior couple, this could mean suddenly seeing $13,000 to $15,000 more of their annual income become taxable overnight. Scientifically, this creates a middle-income trap. If your property taxes and home insurance premiums have surged, as they have in nearly every state over the last 3 years. Losing this massive deduction is the equivalent of a sudden, forced expense that many fixed-income budgets simply cannot absorb. The vivid reality of this change is that thousands of seniors who haven't itemized their deductions in nearly a decade will be forced back into the complex world of Schedule A. If you aren't prepared with a productivity system to track medical expenses, mortgage interest, and charitable gifts, you are essentially leaving your home equity unprotected. In 2026, the IRS isn't just looking for your income. They are counting on your lack of documentation. To protect your home, you must shift your mindset now. Start treating every pharmacy receipt and utility bill as a brick in the wall defending your property. By anticipating this drop, you can implement deduction bunching, accelerating major home repairs or charitable giving into the years where they provide the most tactical advantage. This isn't just about filing papers. It's about ensuring that the standard deduction drop doesn't become the reason you're forced to downsize against your will. Number 4. Property tax liens. While the federal standard deduction is shrinking, a parallel crisis is brewing at the local level that acts as the final straw for many senior homeowners: the aggressive rise of property tax liens. In 2026, we are witnessing a perfect storm where the temporary relief from the One Big Beautiful Bill (OBBB), which actually increased the state and local tax SALT deduction cap to $40,400 for this year, is being completely overshadowed by skyrocketing home assessments. For a senior living on a fixed income, a property that has doubled in value over the last 5 years isn't just a win for their net worth, it is a massive liability. Scientifically, property tax rates are sticky, meaning they rarely go down even when budgets are tight. When a senior cannot keep up with a 10% or 15% jump in their annual tax bill, the local municipality doesn't just send a late notice, they sell a tax lien certificate to third-party investors. The vivid reality of a tax lien is that it places a leash on your home equity. In many states, these investors can charge interest rates as high as 18% to 24% on the unpaid tax debt. For a 75-year-old widow or a retired couple, a $3,000 tax shortfall can balloon into a $10,000 debt in just a few years, eventually leading to a foreclosure that forces them out of a home they've owned for decades. This is why the 2026 SALT cap increase is a double-edged sword. While it allows you to deduct more on your federal return, it proves that the government expects your local taxes to stay at these record highs. To protect yourself, you must be productive and proactive. Appeal your property tax assessment the moment it arrives in the mail. Don't wait until May to realize your paper wealth is making you house poor. Understanding this lien process is the only way to ensure your home remains a sanctuary rather than a source of predatory debt. Number 5. The 1040SR secret. As the 2026 tax landscape becomes increasingly volatile, the IRS has quietly reinforced a specialized tool that acts as a survival kit for homeowners: Form 1040SR, or the U.S. tax return for seniors. While it carries the same legal weight as the standard 1040, its design and integrated benefits are a masterclass in financial productivity for those 65 and older. The most significant secret hidden within this form for 2026 is the implementation of the enhanced deduction for seniors, a provision born from the One Big Beautiful Bill, OBBBA. This isn't just a minor adjustment, it is a powerful $6,000 shield, $12,000 for married couples, that stacks directly on top of your existing standard deduction. Scientifically, this dramatically raises the tax-free floor of your income, meaning a single senior can now earn nearly $24,000 before a single penny of federal income tax is even considered. Vividly imagine the relief. For many, this new deduction effectively wipes out the taxable portion of their Social Security benefits entirely. In a year where every dollar is being fought for by rising utility costs and insurance premiums, Form 1040SR serves as the primary defense mechanism to keep that cash in your bank account instead of the government's coffers. The form itself features a high-contrast, larger print layout specifically designed to reduce the filing fatigue that leads to costly errors. More importantly, it features a built-in standard deduction chart that ensures you don't miss the age 65+ bonus or the new OBBB boost. By using this form, you are choosing a more streamlined, error-resistant path to protecting your home equity. To maximize this, you must ensure you meet the 2026 income thresholds, as the full $6,000 benefit begins to phase out for single filers with a modified adjusted gross income over $75,000. Transitioning to 1040SR is the ultimate low-effort, high-reward move to ensure your retirement income remains yours. Number 6. Energy credit expiry. The 2026 tax landscape has introduced a brutal reality for seniors looking to maintain their homes: the complete termination of federal home energy incentives. Under the newly enacted One Big Beautiful Bill (OBBBA), the primary lifelines for home efficiency, Section 25C, the Energy Efficient Home Improvement Credit, and Section 25D, the Residential Clean Energy Credit, officially expired on December 31, 2025. This isn't just a policy shift, it is a financial cliff. Scientifically, older homes lose efficiency at a compounding rate, and for many seniors, the 30% tax credit was the only way to afford the $15,000 to $20,000 cost of a new heat pump or solar array. Without these credits, the full sticker price of essential home maintenance now falls entirely on the homeowner, creating a massive barrier to aging in place. Vividly imagine a scenario where a 30-year-old HVAC system fails during a 2026 summer heatwave. In previous years, a senior could rely on a $2,000 annual credit to offset the cost of a high-efficiency replacement. Today that credit is $0. This maintenance trap is one of the primary drivers forcing seniors out of their homes. When the cost of a single major repair exceeds their annual discretionary income, the only remaining option is often a predatory high-interest loan or a forced sale. The productivity hack here has flipped. Instead of chasing credits, you must now pivot toward local utility rebates or the lease/PPA model, where third-party companies still claim commercial credits and pass a fraction of the savings to you. However, you must move with urgency. The commercial construction deadlines for these projects are also tightening, with major shifts coming as early as July 4, 2026. Protecting your home now means securing your building envelope before the cost of going green becomes a luxury that only the wealthy can afford. By understanding that the federal well has run dry, you can stop waiting for a tax break that isn't coming and start negotiating for the best cash or lease deals available in this new incentive-free market. Number 7. RMD age shifts. As we move deeper into 2026, a massive structural shift in retirement law, the Secure Act 2.0, is creating a timing trap that could inadvertently trigger the highest tax penalties in the IRS playbook. For decades, the age for required minimum distributions (RMDs) was a static target, but we are now in the heat of a phased increase that has moved the goalpost to age 73 for those born between 1951 and 1959. This isn't just a win for tax-deferred growth, it is a scientific complexity that is catching thousands of seniors off guard. The most dangerous date on your calendar right now is April 1, 2026. If you turn 73 in 2025 and listen to the common advice to delay your first withdrawal, you have just a few weeks left to pull that money out. Failing to do so doesn't just result in a warning, it triggers a revised 25% excise tax on the amount you failed to withdraw. While this is lower than the old 50% penalty, for a senior with a $500,000 IRA, a missed RMD can still result in a $5,000 penalty, cash that is stripped directly from your home maintenance or property tax fund. The vivid double tax reality occurs if you wait until this April deadline. By delaying your 2025 RMD to April 2026, you are legally required to take your second RMD, for the current 2026 tax year, by December 31st. This results in two massive distributions hitting your taxable income in a single calendar year. This income spike can artificially inflate your tax bracket, trigger higher Medicare Part B premiums, IRMAA, and even make more of your Social Security benefits taxable. It is a productivity nightmare that effectively forces seniors into a lower standard of living or, in extreme cases, creates a tax bill so large it requires tapping into home equity to pay the IRS. To protect your sanctuary, you must treat your RMDs as a precision strike. Coordinate with your custodian now to automate these withdrawals, and if you don't need the cash, consider a qualified charitable distribution (QCD) to satisfy the RMD without adding a dime to your taxable income. Understanding these shifting ages isn't just about retirement, it's the primary defense against a government-mandated wealth leak that threatens your ability to stay in your home. Number 8. The Caregiver Credit. The 2026 tax year has introduced a critical lifeline for this sandwich generation, those adults aged 35 to 65 who are simultaneously raising children and supporting aging parents. As the cost of professional assisted living facilities rockets past $60,000 a year, more families are choosing to move their parents into their own homes. To combat the resulting financial strain, the IRS has clarified the credit for other dependents (ODC) and the newly expanded caregiver support provisions under the 2026 tax code. This isn't just a thank you from the government, It is a strategic $500 non-refundable credit that can be claimed for each qualifying parent you support. To qualify, you must scientifically prove that you provided more than 50% of your parents' total financial support for the year, including food, lodging, and medical care. In 2026, the income threshold for a parent to be considered a dependent has been adjusted to $5,200, excluding most Social Security benefits, a narrow window that requires precise, productivity tracking of every expense. Vividly imagine the impact. By claiming your parent as a dependent, you don't just get the $500 credit, you may also unlock the ability to file as head of household, even if you are single. This shift alone can increase your standard deduction by thousands of dollars, providing the necessary liquidity shield to keep your family's multi-generational home out of tax foreclosure. Furthermore, if you are paying for in-home care or adult day centers so you can remain at work, you can tap into the Child and Dependent Care Credit, which covers up to 35% of $3,000 in expenses for one qualifying individual. This is found money that acts as a direct subsidy for your home's mortgage or property taxes. To maximize this in 2026, you must keep a meticulous log of all shared household costs, utilities, groceries, and repairs, and divide them by the number of residents. This level of organization is the difference between a rejected claim and a significant tax refund that preserves your family's legacy. By acting as the financial architect for your parents, you aren't just caregiving. You are strategically deploying the 2026 code to ensure no one is forced out of the home due to rising care costs. Number 9. Medical mileage. As we navigate the complexities of 2026, many seniors are overlooking a quiet but potent tax shield that can save thousands in home equity: the medical travel deduction. While the business mileage rate has climbed to record highs, the IRS has set the 2026 medical mileage rate at 20.5 cents per mile. On the surface, half a cent less than last year might seem like a step backward, but when combined with the skyrocketing costs of healthcare and frequent specialist visits, these miles become a massive asset. Scientifically, the IRS allows you to deduct unreimbursed medical expenses that exceed 7.5% of your adjusted gross income, AGI. For a senior living on a fixed retirement income, reaching the 7.5% threshold is easier than ever due to rising Medicare premiums and prescription costs. By failing to track the miles driven to the pharmacy, the doctor, or even out-of-town specialists, you are effectively leaving a significant portion of your income unprotected and vulnerable to the liquidity squeeze that leads to forced downsizing. Vividly imagine the cumulative power of this deduction. Every trip to the cardiologist, every weekly physical therapy session, and every drive to the imaging center adds up to a paper wall that lowers your taxable income. In 2026, the IRS isn't just looking for your doctor's bills. They are looking for the contemporaneous logs that prove your travel was essential. If you aren't using a simple digital log or a dedicated notebook in your glove box, you are essentially volunteering to pay more in taxes than required. This isn't just about saving on gas, it's a productivity strategy. By lowering your taxable income through medical mileage and expense tracking, you can stay below the thresholds that trigger higher Medicare Part B premiums, IRMAA, or the taxation of your Social Security. To maximize this, you must also include parking fees and tolls, which can be deducted on top of the 20.5-cent rate. In a year where every dollar counts toward keeping your home, treating your vehicle as a tax-saving machine is the most productive move you can make. Documenting these miles is the primary way to ensure that your health needs don't become the catalyst for a financial crisis that threatens your front door. Number 10. Step-up basis risk. The final and perhaps most astonishing threat to senior home equity in 2026 revolves around a technicality known as the step-up in basis. For decades, this rule has been the bedrock of generational wealth, allowing heirs to inherit a home at its fair market value on the date of the owner's death, rather than the original price paid 40 years ago. However, under the newly passed One Big Beautiful Bill (OBBBA) and the shifting legislative climate of 2026, this provision is being scrutinized as a loophole that the government is eager to close. Scientifically, if the step-up in basis is repealed or even capped, as proposed in the 2026 Fair Share Amendments, the tax liability on a family home could jump from zero to hundreds of thousands of dollars the moment it passes to the next generation. Vividly imagine the inheritance trap. A home purchased for $50,000 in 1980 is now worth $850,000. Under current rules, your children inherit it with a stepped-up basis of $850,000, meaning they can sell it tax-free. But if 2026 legislation forces a carryover basis, Your heirs would owe capital gains tax on that $800,000 of appreciation. This massive, unexpected tax bill often forces a fire sale, where families are compelled to sell the childhood home just to pay the IRS. This is the ultimate forced-out scenario, not for the seniors themselves but for the legacy they worked a lifetime to build. To defend against this, you must look into upstream planning, or the use of irrevocable trusts before the 2026 window tightens further. This isn't just about accounting. It's about ensuring that your front door doesn't become a revolving door for the tax collector the moment you're gone. Taking action now is the only way to lock in your basis and protect your home's future. The IRS 2026 rules aren't just numbers on a page. They are the new gatekeepers of your front door, but now that you have the playbook, the power is back in your hands. Don't let your legacy be a casualty of a missed deadline. Act today, secure your equity, and keep your sanctuary safe. If this deep dive into the 2026 tax trenches helped you breathe a little easier, smash that like button to fuel the algorithm, subscribe to join our inner circle of financial fortress builders, and share this with one person you care about to ensure their home stays exactly where it belongs, in the family.